me bring on board Nitin Agarwal, who's head of BFSI Institutional Equities at Motilal Oswal Financial Services, joining us this morning. Nitin, there's been plenty of banter, PSU versus private. Let me start with that because that's currently the big debate. And we've seen a large re-rating within the private basket that we've seen in terms of valuations. And therefore, is this an opportunity to buy is what I'd want to kind of first off delve in with you.
Right. See, while there is a lot of macro noise going around, we are like in a very uncertain environment overall. But banking earnings overall still looks to be going on a decent footing. And right in this quarter, we will continue to see some recovery in terms of earning growth. We had a very patchy earning growth over the last year or 18 months or so as the margins continue to decline every successive quarter. And with things stabilizing, with credit growth looking to gain trajectory, gain traction, and asset quality overall holding up very well. So that all is driving a earnings recovery. I think the stock performance will be more of a function of how the investor sentiments are, how the news flow as such goes to be from here, and that all will drive the performance. But we continue to maintain a positive view on the sector, and we believe that the valuations are very reasonable in context of the earnings outlook for the overall space.
Right. Nitin, what do you make of this argument that PSUs have been gaining market share versus some of the private sector banks, and that could well continue given that you've got a steady recovery pipeline which is coming through for PSUs? You've got an ROA of 1%, which they've been doing, which they are very happy doing. They don't need to justify a 1.5 or 2% ROA, given that they are trading at 1 or sub 1 time book, at least most of them. And therefore, the profit pool within the banking industry will likely shrink. What do you make of that argument?
I think, yes, last 2 years, both in FY25 and FY26 running, we have seen that PSUs at the margin have gained market share. So if I look back between FY11 to 21, over 10 years, PSUs lost 20% market share. And now, over FY25 and 26, we have seen them marginally gaining share. And given that most PSUs are now not as hesitant to deploy liquidity, they are okay to have some mismatches between loan and deposit growth, because otherwise there was always a focus to maintain parity between the two. And now we have seen large PSU banks also delivering pretty healthy growth. In fact, SBI is targeting 13 to 15% loan growth over the year. So which is where PSUs will end up doing well in terms of market share in 26. And this trend may likely continue to a smaller extent in 27 also. And I think, therefore, going forward, and now that PSUs, they've improved on earnings profile, they are very well capitalized. Many of them have raised capital on their own, and which places them well to sustain this traction over the next 2 years.
And therefore, Nitin, what therefore makes a case for an investor to go and buy private sector banks? Because you've got private sector banks trading at roughly 2 to 2.5 times book. You've got 10 to 15% earnings growth there. You've got very similar kind of growth levels in PSU banks, but they trade at 1 time book. So what really, therefore, would urge an investor to go and play private sector banks? Is it just the cyclicality, and that you're saying is beyond FY27 or FY28 also, maybe?
I think for now, it's like a catch-up that the PSUs have done. And certain private banks got a little more impacted due to the overall unsecured cycle. But as the overall momentum picks up in respect to the credit growth, both in retail, the corporate, the SME, which has been doing well, I think the privates also will gain traction onto the loan growth. If you look at the largest private bank, HDFC Bank, it had a rough FY25 in respect to the loan growth because the entire focus was on reducing the CD ratio. And now, with that, the focus on that ratio easing somewhat, and it's related to the note that we have also written about the LCR and the NSFR ratios. I think incrementally we will expect private banks also to gain traction. And therefore, all the 3 top private banks, Axis, ICICI and HDFC Bank, will likely report stronger growth over FY27 and beyond. And which makes the case for private bank very well in place in our view.
Point taken, Nitin. What do you make of the kind of asset quality that PSU banks have been showcasing? Do you believe it's just a cyclical kind of a tale which is playing out, which is likely maybe a 2-3 year story where growth will come back and thereafter again, you might see asset quality issues, or do you believe that structurally things have changed within the PSU banking basket?
No, I think asset quality, there is no risk lurking around. While yes, there has been a significant improvement from the old days wherein PSUs were reporting very high levels of delinquencies, and we have seen now many PSU banks reporting benign credit costs. In fact, the provisioning coverage for PSUs today at a sector level is higher than private banks. And given that the recoveries are still continuing and the incremental slippages are in control across all PSUs, we expect overall credit costs to still remain well within control in FY27 also.
And Nitin, if within the private banking space, you already gave us three names: Axis, ICICI, HDFC. That's the way you're likely playing private banks. Would you also venture into some of the smaller names?
So overall, our preference in private has been more towards the larger banks, because if you look at like this year has been a year wherein the larger private banks have not delivered any returns. So therefore, the valuations for these names have corrected to the extent of the ROEs that they make. And both ICICI and HDFC Bank therefore look very attractive. And we are of the view that growth from here for both these banks will continue to strengthen. And we will see for example, for ICICI, we will see growth somewhere in the high teens, about 15-16% for FY27. And HDFC Bank also has been indicating that the growth will be ahead of the industry in FY27 and closer to the in line to the industry in FY26. So, which is where we like these names better than the others within the private banks. And amongst mid-sized names, we have been more positive on AU Bank all through over the last more than a year now, and we continue to maintain that call on the bank.
You also cover NBFC names. Again, there's been a sharp re-rating where NBFCs is concerned. From the highs, some of the top-rung NBFCs have corrected meaningfully. Your top names within that basket, and given that a large part of the margin accretion is behind us where NBFCs is concerned, would you therefore say that ROAs might be subject to some contraction, or can we only strengthen from here where ROAs is concerned?
I think we will like to play NBFCs for growth. While I take your point that margin expansion possibilities are limited, but I think we'll still see some accretions and margins for the vehicle financiers, and which is where we remain selective on the space as a whole. And we continue to like, say, Shriram Finance amongst the NBFC space a lot. And I think Bajaj, for example, also has corrected a lot. And given that the outlook on credit, both asset quality and the growth, while we still in a very uncertain environment, so we want to watch for one more quarter, but hopefully things will be better off in FY27 versus how they have been in FY26. So which is where I think at a certain price, we will want to turn more positive on Bajaj Finance also.
Right. Nitin, talk to us about competition now, because obviously PSU banks have been able to sacrifice some amount of profitability from the entire banking and lending profit pool because they are more comfortable with a lower ROA kind of a trajectory. Does this mean that yields overall industry-wide have come off meaningfully according to you? You've seen multiple cycles, so you've got a great lens into this. And do you believe pricing of risk is being done appropriately at this point across the board, or are there pockets where risk has not been entirely fairly priced?
I think the lending markets are very competitive right now. That's the feedback that we get from most banks. We have seen a good traction across corporate lending also in the last quarter. Like, for example, just SBI reported a 6% sequential growth in the third quarter for the overall portfolio. And that was very well kind of broad-based growth that they reported. And the similar kind of momentum is going on in the fourth quarter, which is seasonally the stronger quarter for the industry. And which is where on the margin side, we believe that the quarter will be very range-bound. There could be some very marginal decline because the complete pass-through of the last rate cut in December will happen in this quarter. But at the same time, there will be some compensating factors also, which is where there is a possibility that some banks may go on to report positive delta. But overall, in terms of yields, I think we are going to see a very range-bound kind of a lending yield because banks are not really able to cut deposit rates. The deposit rates, the bulk deposits, and the wholesale deposit rates have hardened, and which actually led to one or two banks recently raising MCLR rates. So we will have to still watch out on that front. And but over the year, our view is that margins will still expand. The quantum of expansion will be lower versus what we were looking at 3 to 4 months back, given how the rate have moved in the industry. But nevertheless, in FY27, we will still see better margins versus FY26.
Nitin, one piece which is playing out again is MFI and MSME, and also unsecured to some extent, because that's where a bulk of the problems actually resided over the last couple of years. You believe a re-rating within that pocket could well be warranted, because you seem to be suggesting that you prefer the larger banks, but this is a pocket which is largely influenced by some of the smaller banks, and they are able to grow much faster in good cycles. Do you believe that good cycle could well be a year or two away from us? And why is it then that you prefer the larger banks?
Yeah. So I'll say yes, technically within the smaller banks, we have recently upgraded Bandhan. So it was after 5 years of neutral that we were writing on the stock, we upgraded the stock in January. And with the same view that you're talking about, that MFI cycle is now moving to more towards normalcy, and therefore the delinquencies and the credit costs will likely normalize in the coming quarters, which will lead to an ROA uptick for the bank. So for the same reason, we have taken a positive view on this industry and upgraded Bandhan Bank recently. And amongst other names, we like RBL Bank, and that's another name that we upgraded more than a year back. And while it's a name which I think it's a bank of possibilities right now, we still need to see as to how the execution happens after this change in the promoter and the kind of growth that the bank starts to deliver. But there is a possibility that we will look at the industry-leading growth by the bank, given that the tier 1 itself will be like the highest in the industry.
Nitin, thank you so much. Comprehensive conversation with regard to the lenders. Thanks so much for coming in and speaking with us.
Thank you so much.
All right, and what we'll do